Welcome back to the Alts Podcast. I'm your host, Horacio Ruiz. We bring you industry leaders and creators to give their insights on the rapidly changing and exciting world of alternative assets. Opinions expressed on this podcast by the host and podcast guests are for informational purposes only and should not be considered investment advice. Podcast hosts and guests may maintain positions in the offerings discussed in this podcast. Thank you for joining the podcast. Today we're talking to John Green, the founder and CEO at Nada. Nada is an investment, finance, and banking platform that allows investors to own shares of a top city's real estate market. With a minimum investment of $100, an investor can own a slice of a city's real estate. In this episode, we talk about how Nada uses its Homeshares program to give homeowners greater access to their home equity at lower costs than a traditional bank, and how Nada uses its stake in that equity to create city funds for its investors. John talks about the current city funds of Miami, Tampa, Dallas, and Austin, and how investors benefit from equity dividends, rental payments, and a secondary trading platform to be released later this year. I hope you enjoyed my conversation with John. All right, guys, thank you for joining us on the podcast today. We have another great company, nada.co is their website. It's a real estate startup doing some real cool things, allowing people to do things that they maybe traditionally haven't been able to. We have John Green, Mr. John Green, the CEO of Nada. Welcome on the podcast, John.
Hey, thanks for having me. Really appreciate the platform you guys have created and the opportunity.
Yeah, absolutely. I know that we were very excited about your company, what you guys are doing. We have a great list of guests that have come on the podcast in real estate, and so you guys are definitely doing something different, something we haven't seen before, and that's always exciting. And I just kind of want to start off, with you, John, kind of like the kind of have a big picture of the company, large overview. Nada does a couple of things
Yeah.
differently. One of them is giving access to home equity. The other one is kind of creating this real estate fund where you're owning basically pieces of the city, so to speak. And so I just want to let you kind of talk about it. Talk about what
Yeah,
Nada
yeah,
is and what you guys are doing.
yeah. That's great. I appreciate it. Yeah, we are maybe a little bit different in that way, in that we do serve two sides of the market. We're a platform that has a single mission, that is to make real estate more accessible for everyone. So for us, on one side, on the demand side, if you will, we issue and manage a series of real estate funds that we call city funds. And city funds are designed to be index-like funds that represent a single city's residential real estate market. So we have Austin, Dallas, Miami, for example. And investors can invest directly into that fund, which gives them exposure to a diversified portfolio of real estate investments in that city. So they get the simple exposure to that, again, that residential real estate market. And one of the ways we're able to do that and do it efficiently is how we support the supply side. Nada also originates consumer finance products. And so for homeowners, we have a financial product. It's a home equity investment product that we call Homeshares. And a home share allows a homeowner to sell a fraction of their home equity. In exchange, they get cash today, and then we get a real estate asset, a lien deed secured interest in their home's future value. And so that ends up being the majority asset that each city fund is owning. And so when you put those two together, you've got a homeowner that is able to access equity without the burden of monthly payments or added debt or anything such as that. And you've got a fund that has exposure, direct exposure to home owner occupied home equity in some of the largest cities in the U.S. So it's very efficient, very diverse, and it does a good on both sides, which is very important for us.
Yeah, those are two the two big things that you guys are doing, and I kind of want to take one at a time and do like sort of speak a deep dive into each one.
Perfect.
And I want to start off with the home equity side because I really think that kind of lends itself to the home shares program that we'll talk about in a little bit. But the home equity side, right, is so interesting because it's a little bit different. So you are a homeowner is able to access equity in their home, okay, with you guys providing that equity. Okay, there is kind of nothing different, but the difference is this. So um, when the homeowners get the equity, you guys almost become partners with them, right? You kind of own a percentage of their home. You become a partner with them, and you kind of share in the appreciation of their home. And in return, the homeowner, the equity that they receive is different from say a traditional loan that they would get at their bank,
That's
right?
right. That's
Mhm.
right. Yeah. So a homeowner today that wants to cash out their equity in their home, they're limited to a couple of traditional methods. One would be selling their home out entirely and buying a new home or going into renting. That's very disruptive. Maybe people not trying to move. The other would be to take on debt. So you could do a cash out refinance. You could do a home equity loan or home equity line of credit. So where we come in, we add an alternative to that. So a homeowner is able to sell a piece of their equity that they've built up in their home. In exchange, we get a percentage of that home's future value, and we give them cash today. So it's an investment. And as you stated, we are in effect partners with the homeowner in that investment. That investment being their home, and by being an equity investment instead of a debt product, we do share in the upside and the downside. So when we place an investment, we're betting in the home and the homeowner. We don't technically have ownership. The owner retains ownership. We just guarantee a share of the home's future value. And we're basically betting on the homeowner and the home just as they are.
Gotcha, gotcha. Okay. Um, so I kind of want to have a little bit of an example, and I kind of just to make it easier for me to understand.
Yeah.
Um, so let's say that somebody's home is appraised at $100,000, but they still have a mortgage for $50,000, right? So then they have an equity of 50K. Uh,
Hmm.
would they say, hypothetically speaking, would first of all, would the homeowner be able to take out, ask you guys for all the equity, which would be $50,000 there? And if you guys are able to provide that $50,000 in equity, do you guys then essentially become, let's say, 50% homeowner of that property?
That's a good question, and it's a little bit different because when you look at a home, really what the owner has is just the equity.
Hmm.
The rest of it is owned by an institution, typically, the mortgage lender or the bank. So it's not really theirs to give away. Maybe that's the first way you'd look at
Yeah.
it. I get the way you scaled down the math to make it simple, and I like that. So I'll scale down the size of that we would potentially cash out here. If a homeowner has, again, I'm restated, $100,000 home, they have $50,000 worth of equity, and they want to cash out, say, $10,000 of that 50,000 that they have in equity. We would do that. We would buy that percentage. We'd give them $10,000 in cash, and in exchange, we would then secure 20% of their home's future value. That's what the underlying instrument is, and that's because in this case, 10,000 is 20% of 50,000. If I'm doing quick math correctly,
Okay.
so that's why it's an apples to apples. Like we're giving cash based on current equity value, and
Okay.
then in exchange for that access to cash the homeowner is getting today, we're saying okay, we're going to get that future share.
Okay. What about if and 10K sounds reasonable, right? But what if a homeowner comes to you and says, "I want all my equity"? Is that something that you guys? I don't know if you encounter that often, or is that something where you're like, "Well, let's see if the numbers make sense."
Yeah, it's definitely the latter. I mean, in this case, it's not dissimilar to a mortgage product.
Mhm.
We are underwriting the risk of our position in the homes, and one of the things we do like about this, because we do look at it as an investment asset, is that smaller positions, not overly levered, is a more diverse kind of downside protection to build a basket of assets. So no, we won't go anything above what we call an 80% CLTV. So CLTV in this case is combined lien to value. So it'd be the combination of what they owe on any outstanding mortgage debt, in addition to the cash that we're giving them. It cannot exceed 80%. Said differently, the owner has to have at least 20% equity in the home at the end of the deal.
At the end of the gotcha. Okay.
Yeah.
So when someone's looking at that, so essentially you're not providing a loan either, right? You're providing straight up equity. The when the homeowner applies to a program like this, what are the fees associated with it? And I guess kind of related to that is, how is this a different process, say, than what you mentioned before? Going to the bank, having
Mhm.
a debt equity loan, something like that.
Yeah, yeah. Well, I think the first thing is it's a lot less time consuming to apply and get funds. We're able to close and get funds in 15 days
Wow. Okay.
because it's a lighter underwrite. It's an investment primarily in the collateral and less of an underwrite of the consumer,
Mhm.
as long as they're current on mortgage. That's how we look at it. As far as closing costs and fees, there are some standard pass-through fees that the owner has to pay. So, such as we do process closings through title and escrow, but it's not as expensive as if you were to do that with a full refinance or a home equity line of credit, just because the instrument behind it is not as substantial. So, similar closing costs in terms of things that we're handling that are third parties are doing to do a certain service, like a property inspection,
Mm-hmm.
a soft credit report is pulled. But compared to other ways someone would cash out equity, it's cheaper, it's less cost in closing, and faster to close. Uh, but the big ticket is there's no interest rate, no monthly payments. Um, that's the main distinction.
Yeah, at that point, since you say are becoming a partner, right? It's not a, and correct me if I'm wrong. I just want to kind of clear up for anybody that maybe is listening.
Mm-hmm.
Um, essentially, it's not a loan product, right? Essentially,
Correct.
it's
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 not a
gonna,
loan at all. No.
yes.
So it's an option contract. So those that might be familiar with investing in startups and venture capital, and you guys being alts, that's a big alts category. In case this resonates, that is a very simple way. So it's not dissimilar to like what a safe note is.
Mhm.
We're investing in and securing it by an option agreement, which we then is exercised at certain trigger events upon the sale of the home, the maturation of term, or other events to the senior debt, so like the refinance of primary mortgage or payoff of mortgage. These things would bring us to the table.
Gotcha. Um, and I think it's so important to talk to begin with this here because what you're able to do through this program is then kind of give life, right, in a sense to the other program that you have, and maybe something that our listeners would be kind of more interested in as
Mm-hmm.
investors, which is the Homeshares program, right?
Well, yeah. So the homeowner product is Homeshares. The overall fund is Cityfunds.
City funds. I'm
So
sorry. Yes, the
yeah,
city funds. I'm sorry. So the Homeshares kind of helps out with the city funds.
it does. Yes.
Um,
Yeah.
and I find it so interesting because there's different ways that we can describe this, but I kind of want to describe the city funds again, which you mentioned before, which is you're able to own sort of like it's an index fund for a city, and right now you
Mhm.
guys are based out of four cities. Um, and but how you're able to do that is you're able to kind of get into the cities through the home shares program. So you're basically fractionalize stake in these homes, and then you're able to create these funds in the city. And right now you guys are in Miami, Tampa, Dallas, and Austin.
That's right.
Um, could you describe to me a little bit more about how that works?
Yeah, sure. Yeah, I'd love to. So, just like if you look at the home itself as a single asset, when we make an investment in a home through home shares, we represent around 15 to 20% of the home's value. So, we're not overexposed to that single asset. Now, we take that and we do it 20, 30, 40, 50 times in a city, and we have investments in typically owner occupied homes in that city. And even within that asset, we're not overexposed. So, critical thing is city funds by virtue of the home shares asset is that we have tremendous diversification.
Mhm.
We also gain a great deal of operational efficiency because unlike trying to represent 30 homes in Austin, for example, that are all rental properties, one would require much more capital to secure, and then two require much more operational efforts in order to place and manage the properties, place tenants, etc. And so in our case with a home share, we effectively have a self-managed asset because the owner retains ownership rights and covenants, as well as the majority equity upside. So there's a lot of alignment that we see in that asset that allows us to access a market that may otherwise not be affordable. And again, diversification and total efficiency of a fund.
Um, so now, what kind of homes are you using for the fund, right? So in
Mm-hmm.
I'm imagining that since you guys are offering this home shares program, that it's mostly residential,
Yep.
um, not necessarily single family homes, and not necessarily rental properties or commercial properties.
Yeah. So each city fund is exclusively single family residential.
Okay. Yeah.
Within that, it's your pretty standard 1 to 4, but we will also include townhomes.
Yeah.
We don't invest in condos. There's certain reasons for that. I mean, there's kind of a domino effect of a condo. That way, we're singly exposing to a very specific sub asset type within that market. Um, and then we will invest in investor owned properties as well. But as part of our portfolio construction, we'll do a smaller allocation of that. 10% would only go into that. and the vast majority, especially in terms of units, is into owner occupied homes, single family residential always.
Um, and like you mentioned, I think one of the advantages there is that they're actively managed because they're owned by their homeowner by the
Yeah.
homeowner. So there's little, I would imagine, little overhead there. Um, Now, what it would like you mentioned the ratio between the homes that are a part of your home shares program,
Mhm.
and you said you're also investing in some investment properties. There's a small ratio. Do you have another strategy for acquiring homes? Like, is Nada actively buying homes of your
Mhm.
own to include in the fund? And I'm wondering kind of what that ratio is. How many of those homes in each city, right, are say a part of your home shares program, and how many of those homes are say maybe homes that you've put your own equity into, your own kind of
Yeah.
investment into? Yeah.
No, that's a great question. So portfolio strategy in construction is critical to us as well. The current stage of the funds, we are investing in single family rental properties, whereby, to your point, we're buying a property outright and we're placing a tenant in it and owning it. And so we're doing that because we want to have an income producing element to the funds early on, because the equity investments have a longer term. They're typically paying off in 4 to 5 years. So it's easy to look at it from a unit standpoint. We are 10 to 1, 10 to 1 being 10 equity investments to one rental property. That's our
Mhm.
current construction per fund. But as I was saying, even in the equity investments, we're doing 10% of those are investor equity investments, investor owned properties, as opposed to owner occupied. And that's because those carry a shorter term. We offer those with a 1 year term. So that way, again, it's a cash flowing issue, but we're de risking based on exposure to those as well. So we have those three types per city fund.
Gotcha, gotcha. I kind of want to take a step back for a second.
Yeah.
You did mention, we've got properties in Miami, Tampa, Dallas, and Austin. Um, any reason for choosing those markets? Um,
Hmm.
how do you see, those properties, kind of those cities working out? And maybe even talk a little bit about the current state of the market. There's a lot of conflicting information out there where one
Yeah.
minute you think the real estate market is going to crash because such and such reason, but then you see other things where it's like, no, real estate's actually doing, really well. It's just kind of humming along.
Yeah, yeah. I I like to say we don't try to predict the future, but we have a lot of history to point to. So real estate's been one of the most stable asset classes, forever. Just look at history, and so that's really how we first look at it. I'd say today we're able to make investments in a stabilizing market. It's kind of reckless to predict the future. A lot of the articles you're referring to generate a lot of clicks because a lot of people own homes, which again is the thesis of our whole fund, is that residential real estate touches pretty much everyone's life on a daily basis. So if I'm a journalist and I write an article about the home prices are going to collapse, the probability of that impacting a lot of people personally is high. Anyways, not get too off topic. That's a bit of my viewpoint on some of those articles. So
Yeah,
again,
yeah,
point to the history, and then getting into you guys. I mean, you guys are alts, right? So alternative investments, whether it's collectibles, crypto, etc. Real estate is really the OG for alts, and so it's kind of looked at weird, but it is one of the most stable, and we're all about making it more accessible. So when we look at a city, we look at a couple of things. One is, what is the home price appreciation of that market over a longer period of time, over a 20 to 30 year time frame, and then break it into smaller tranches so we see where it's at. And through that, we can identify. We've got 30 MSAs that we've identified to be future city funds. The other thing we look at is really the housing, call it the stock itself. Maybe it's best to give an alternative example, like Boston or San Francisco would be great markets. They're marketable and how they're presented. But the housing there is very unique, very nuanced. So it'd be more difficult for us to create an index-like exposure to those cities. So they're not currently on the roadmap. I believe in time we can mature with data science to get better there. But that would be one of the things we look at. So we look at cities that have more predictable housing units, builds, PUDs, planned unit developments, etc. And then we look at really the marketability of the city. You know, there's a big thing around we're exposing people to culture as well. Those are, I think, again, the big things.
sure. Real quick, like, what do you mean? Like, what makes a city more, say, um, quote unquote predictable, right? Like in
Yeah.
terms of like what is that? Just like records the availability of records, or just sort of uh,
More around like so. A PUD is a plan unit development to where a lot of the housing is built up in communities where builders come in and build homes that have a lot of similar characteristics and a similar age, right? And so you can you can take that. Phoenix is a great market as example there, as opposed to a market like again a Boston or San Francisco where the housing there is, or even in New York, is more older and established, and much more nuanced unit to unit. It is really just simply saying that like markets that have most like characteristics of homes throughout is where we first are going to. And not to make that sound too crazy, that is most markets.
right? Yeah, awesome, awesome. What is the total number of properties? So you have these funds for each city, real estate funds for each city that you can invest in.
Yeah.
Miami, Tampa, Dallas, Austin. Could you give us a number for the how many properties are maybe in each market?
Yeah.
Um, what do the funds consist of? Yeah.
Yes. So Austin is at 26 units that it holds today. Dallas is at 23. And Miami is, I believe we're going to close this month at 12. And then our newest fund, the one that we just launched, is Tampa, and we have four.
Four. Okay.
So in each case, we just started making investments for the funds in August of last year. So that's how quick we're able to deploy capital and gain exposure to each of these markets.
Awesome. Awesome. Now within each of those, I guess index funds for each city, you have, you're planning on opening up a secondary market, like a trading platform for them, which I guess would allow for more liquidity, a change of liquidity, and it kind of gets into a bunch of other things about how, from here we can kind of talk about like how investors can make money, by
Yeah.
trading in their shares. But first, I'd like to, maybe have you discuss like how far away are you from having the secondary trading platform where you're trading shares of each city, and what is your kind of vision for that?
Yeah, it's a great question. So maybe I'll start with the whole design. Again, the reason we created City Funds is we wanted to make City Funds a way for the Main Street investor to be able to own home equity. So we got a minimum buy price of $100, and we wanted to make that a familiar asset class to them. So something that is more liquid than a typical private real estate investment. So that's again the reason we've done all this. As far as having secondary, we do have the business relationships today. So we have a broker dealer that is our secondary broker dealer, and we have an alternative trading system that is an SEC registered system. It's abbreviated PPAGs. So all this is in place. It's really more so when is it coming in terms of a maturation of the fund and when the early investors would be motivated to list their shares for sale. We anticipate that to be Q3.
Okay.
Q3. And this goes into the whole contract of the fund and maybe the home share itself. The home share is an in the money investment day one, just by design. There's no way it wouldn't be. And then over time, home price appreciation rate moves it up. So your main underlying movement of the fund value is you're buying in at a cash value per share, and we're taking that cash and we're going out and making investments that have a multiple on that cash. And then we track the performance of the homes just with the evaluation methodology that we use. And we can go more into this in a minute. And then we publish it, and then that changes the share price through net asset value, NAV. And then that creates a tradable movement. If you bought it at 10 and based on the investments, now it's up to 12, you may be motivated to sell for that difference of value.
And I guess that brings like my a question, like for an investor, say that they're invested in the city fund, um and I don't know if it changes this at all, if there's a change that occurs at all, but like what happens when one of the homes from the home share program gets sold, right?
Mm-hmm.
So um somebody has sold, that you guys invested when the equity, when I'd say when the market value was 100K, and the home is sold for 200K, and let's just say for sake of argument that then you 100, you doubled your investment. um how does an investor in the city funds see that profit, right? um I would imagine that they would see something from that, is it just with their home with their the price of their share rising, or would they see some of that as a payout, as a dividend?
Yeah, it's a great question, and we do have a dividend program with the fund. So each fund is structured as a REIT, so the same REIT rules that apply. You know, our income is paid out via dividends, and our dividend cycles on a quarterly basis. So unlike maybe something someone may be familiar with is investing in like a single rental property or even like an Invitation Homes type REIT that is single family rental, we're not as steadily cash flowing on a minor basis of just rental spread. You know, it is to your point. You know, over time and age, these payoffs are going to happen, and these are larger payoffs, and so that's money coming out of the fund, as well as to bring back why I talked about early on. We are investing in some rental properties, so we have income producing built in. But over time, the dividends become a pretty substantial amount of the fund as well. And then the rest of the money is redeployed to invest in new home equity investments, which
Yeah.
have greater equity appreciation.
Is there even like a timeline for what you're hoping that homeowners share their homes for? So like, let's say that you do give some equity out through the, again, and I want to distinguish the two so the listeners are
Yeah,
familiar with the terms. You give equity through the Homeshares program. What if the homeowners decide not to sell for like another 10 years? Is that something that can happen? Is that
yeah.
okay as you continue to add more properties, and kind of diversify your funds?
Yeah. So the homeowner product has a 10-year term,
Okay.
which requires a forced repayment in the event that we needed to do that. The typical payoff of a home equity investment is a 4 to 5 year payoff. So you look at that like a CPR is a 20-22% per year churn on that asset. But the longer they hold, the greater the equity position is over time by the design of that investment into the home. And so because we're we're valuing this asset through third party valuation methods, the same as if you were to buy a home. Our position in that's going up, and the fact that it's going to monetize at some point, has proven to be just a fact in time. And so the share value of that asset is growing. So if someone holds for a long time, there's going to be some mix of that. It's a lower probability that someone holds over 10 years, but it doesn't directly affect the investor because the investor has the liquidity, unlike most private real estate investment funds where they have the liquidity to sell shares, and they could do so within the first year. So there
Mhm.
is some long-term lockup, as well as they have the passive income component of the dividends that we spoke about.
Yeah. Could you talk a little bit more about that 10-year contract? Is that something, so like, um, and just to clear it up again, like, so you guys provide equity, what does that contract stipulate? So does that mean that the homeowners have to um, pay back the equity, or there's
Correct.
some
Yeah,
form of
we're not giving money
contract?
away for free. So yes, it is a 10-year contract whereby we're giving the owner cash in exchange for their equity. And then at the end of 10 years, if they haven't sold the home or refinanced their mortgage, which is a typical way they're paying off,
Mhm.
if they haven't done that, then our option is exercised, and we can then arrange for a cash payment. And the way that would work is we would get a third party appraiser to go out to the home and appraise the current value, and then we would calculate, our payoff on that.
Yeah. At that point, I guess they would go through, I guess, another means, right? Like maybe a traditional way of, let's say they don't have that cash offhand, but then they could just kind of do a traditional refinance. Um,
Correct.
I'm
Yeah.
even wondering in my mind if at that point maybe even you guys can have a product for that, even, where it's like,
Yeah, and we do today. I think it's a great point. So when I say we do consumer finance, we're a licensed mortgage originator, and so not only do we do equity investments in homes, we also sell debt products, and that's just mortgages. And so when a homeowner gets a home share, they're able to track on a monthly basis their balance, and because we're tracking, we know what their interest rate is, and we're tracking some market interest rates. We can tell them, financially when it makes sense for them to do a cash out refinance to pay off their equity option. And that's part of our business model as well. That way, uh, there's just no pressure on the homeowner to pay off. We have an ongoing relationship.
awesome. So yeah, I guess the kind of going back to that secondary trading platform. Now we've added various ways that the investors can kind of see their payouts. Part of it is get that appreciation, the dividend, the rental payments that you guys are getting from the rental properties, and then also potentially this secondary trading platform. One of the things that I kind of am curious about, right, is a platform like that, right? Like, so it has a certain value. Like each city fund has a value, And as you continue to add properties, right, the value of each fund increases.
Hmm.
And I'm wondering how an investor um, sees that appreciation in the shares that they hold in the city fund. So like if I buy into Miami when you guys are at and correct at 16 properties, I think you said, right, John? If I
Hmm.
buy into the Miami market when there's 16 properties, but then you guys add in another 10 properties, right? Um, how do I distinguish, how much of that Miami City Fund I then own? And I don't know if my question even, is making sense.
Yeah, no, it is. I definitely get the basis of it. I, I I think let's just go to the design of the city fund. So city funds are open ended, what you call evergreen funds, and that means they're always raising capital. So they're not closed end, and it's kind of hard to compute sometimes. It's kind of thinking about a circle. You could think about it for days and never reach an endpoint. So the way that it works is when an investor is investing in a city fund, they're actually getting LLC membership interest in a series of a city fund. So in this case, it'd be Series Austin is an entity. And so because they're getting LLC interest, cash is then pulled by that entity, Series Austin, and then that cash is used to make investments into real estate. And that way they're getting what you call pro rata, an equally distributed um, uh, exposure to the gain from real estate assets, as opposed to kind of a 1-to-1 where you are just in one single property. You get the
Mhm.
benefit of having your money being dispersed across all investments. I'll give you an example of where we're at right now. So if you were to invest into really any of the city funds, they're all currently at the cash share price. That is $10 per share. Yet as of December, we did updated NAV, but we chose not to reprice. So NAV is the value of shares represented by the really how well we made investments. So when we make an investment, we make money on the money that we had. And so Austin, for example, the NAV value is almost $12 right now. And so when we file an SEC update, we will update the new buy price to $12. But right now it's still 10. So on a monthly basis, we file that update, and that's when the price changes. But in the interim, if you buy in, you're able to get that accretive value, whether that value is purely appreciation and equity, or cash flow from dividends.
All right. Um, so yeah, like you mentioned before, that makes a lot of sense. You're basically constantly updating the share price. Let's say once a month you're updating it.
Correct.
And
Yes, and that is actually
I guess my question was like, naturally, as you're continuing to add properties, right, to each fund, and maybe this is my kind of elementary thinking, it's better to get in early, because you know you are getting the share prices at a lower value than you would when you add more properties, which is going to naturally add value to each share. I don't know.
correct. Yeah,
Yeah.
I mean, mathematically, yes, correct. Without trying to, overstate or overpromise any performance. I mean, you are betting in the market and our ability to place investments that are,
Yeah.
cost effective. And so, again, as these equity investments pay off, the gains on the sales paid out. So you want to get that dividend, and then that money is reinvested into a new equity investment, which creates an equity position day one. And so it feeds itself, but it doesn't compound and build consistently because you have a cash flowing element. But let me just say this: I won't argue with your point. I think it's a very valid point.
Okay.
I just don't want to overstate anything.
Let's talk a little bit about the valuation of the properties.
Yeah,
I think anybody that is a homeowner maybe is always interested in what their home is worth, and they go to the tried and true sites, Zillow, Trulia, Realtor, to kind of get an idea of what their homes are worth based off of comps and things like that. How do you value? Do you have uh, what is your algorithm, right? And without giving away the secret, like or what you guys are doing, how do you value each property that you buy, and as you're updating the price of each home?
yeah, it's a great question. And if you put yourself on the homeowner side, and you know that the home share product is sold to a homeowner. So one of the most sensitive things that they have is the value of their home, which is really the basis of how we price that. And so it's something that we take very serious. So we work with third-party valuation models, automated valuation models. We have three in particular that we apply an algorithm on top of to arrive at the most um, confident score output of which value we're originating at. And then once we book that investment at that agreed upon value, that becomes the month over month way in which we're tracking the value of the property. It goes from originating the investment to the net asset valuation of it on a month over month. And so it's an integrated process. Um, and we have a great team that does a lot of the calculation there. And then in the event that we have call it an impasse or a disagreement on value, then we'll go with the tried and true field appraisal to ensure we have a certain confidence and agreeable amount of value.
Awesome, awesome. I kind of want to get into the details of here in the last couple minutes here that we have, John. Let's talk about the investments you mentioned earlier in the podcast. It's for $100. People can get
Yeah.
in and own a piece, a fund of a city, basically a real estate fund of a city, um, which I think is key. But I also kind of wanted to see if you could talk a little bit about like, you know, um, future investments. If some actionable, like how can somebody right now get involved with Nada if, as an investor?
Yeah, it's a great question. So you can find us at nada.co, nada.co, which is just going to direct you to the App Store, Google Play Store. Nada Finance is the app. You can search it by Nada Finance or Cityfunds, and you'll find us. Uh, we like to think we've made it pretty simple to get in the app and make an investment directly from there. And then from there, you're able to track your investments, your performance. We believe in building in the public, so we are very transparent with our activity, managing funds, and just what we're doing. So that's really where you get in, and you can get in early now when the price is still low. Before we reprice would be something I would recommend looking into. That's the quickest way to do so. I can say what's coming up. We've already SEC qualified. Uh, 5 additional cities, and we like to kind of reserve some of that. So I can say the next one that we are excited about is Denver. Denver will be the next city fund coming out.
Awesome, big news. So someone right now that they download the app,
Yeah,
they can come in and start investing in one of the funds. They can start
they
buying some
can. They
of
can invest in all of them. Yeah, we have
that's
recurring investment features for some people that like to put just money aside. We see a lot of customers. We just had a customer this week actually that got a home share where they cashed out 40,000 of their home equity, and then they turned around and put 10,000 into city funds where they took their equity out and then they diversified it across each of the city funds actually. So
wow.
there's if you think about us as a single app and concept, we're the real estate app, like the money app for real estate. If you want to get access to a city's equity, if you want to unlock your own to spend or really whatever you need it for, whether it be school, investments, etc. That's what we do.
Yeah, and I kind of want to leave it here, right? Like, um, I feel like you guys have a great opportunity. You have a whole market to kind of go to. Well, you have these cities that you're operating in, um, but like it's basically convincing somebody to try check you guys out as opposed to say a traditional bank. And you guys are saying,
Yeah.
we have so much more to offer by going with us than if you went the traditional route. And I'm wondering if you could speak a little bit more about that as we kind of finish here.
Yeah, yeah. I don't know if you're leading me into a future product, but we do have a banking product that we're excited about releasing soon. We have a partnership with Visa, and we're building a banking wrapper around all the financial products that we have. And I'll tie it back in. So when we release the Visa Denied Debit card and debit program, homeowners getting cash out with Homeshares will get this money on a not a Visa card, and in doing so, that'll allow us to grant them ongoing cashback incentives because we participate in interchange, and give them a banking element of really a much easier way to access home equity to spend, even in smaller increments after their first, call it draw, to where it can just be more accessible than maybe an IRA when it moved to self-directed, but almost as much as a savings account to where the equity is real and it's liquid. And then on the investor side, we have the ability to add something unique, something that we saw Robinhood build a big thing on, and that is like gifting investment shares from really the ambassadors growing the network. And for us, we're going to have a component to where any investor will have cash management to where they'll receive their dividends, they'll receive their gains from trade, et cetera, in a Nada debit account, as well as just for spending the debit card anywhere. We're going to have a share rewards program with Cityfunds. So they'll have the ability to earn real estate just for spending a debit card. Again, just everything for us is how can we make real estate more accessible? And we're really excited about that. That program is likely to come out Q3, Q4.
Along with the trading platform. So it seems like you guys have a big year ahead of you. And with that, I think that's a good way to kind of recap Nada and what you guys are doing and how you're building the company. So John, thank you again for joining me on the podcast.
Yeah.
I really appreciate it. And we're looking forward to, seeing you guys grow and doing more great things.
That's awesome. Thank you. Thank you for having us.
Absolutely. So guys, thank you for coming on the podcast. Check out nada.co. And again, a big thanks to John. John's mission at Nada is to disrupt the traditional methods of investing in real estate. At Nada, they're building products for all types of consumers, from homeowners seeking greater access to equity to investors who may only have $100 to invest at a time. John finished this podcast with a great vision for Nada's future, rewarding its Homeshares users with a banking card to help them become fractional real estate owners through Cityfunds. Make sure to tune in on March 8th at 2 p.m. Eastern Standard Time, as Nada will host a webinar to give a Cityfunds performance update. A big thanks to John for coming on the podcast. And as always, a big thanks to you for listening. If you enjoyed today's episode, please leave a review or follow us on the streaming platform of your choice. Until the next time, take care.